So the infinite banking concept, you got to also do a couple things. So what's required to make this work? Well, first off, we got to have an insurable person. So because this is life insurance, specifically especially designed and engineered whole life, we got to have a body to insure. The insurance company won't just give you a whole life policy without somebody to insure. So we got to have an insurable body. If you're not healthy, well, we got to find somebody that you can insure and you can be the owner of their policy, which means you got to have an insurable interest. So that's number one. Number two, well, we got to have disposable income to make your premium payments. Remember, these are specially designed and engineered. You want to be able to deposit as much as you can into these vehicles based on what you're currently saving today. And then number three, because these are specially designed and engineered whole life policies, you got to find somebody that actually knows how to build one that will work for the infinite banking concept. So you don't want to go to the insurance store and just find somebody that will sell you a whole life. You want to actually find somebody that knows how to do this, knows how to build these policies. Now, when you design one of these policies, whoever does it for you, you want to make sure that it's designed for cash value. And not just cash value, high cash value. Not death benefit. There's always going to be a death benefit, but the death benefit is going to be relatively low in comparison with how much cash value you're going to build. This is the opposite of how a whole life is normally built. Step number two, we want to open a segregated checking account. Nothing different than a regular checking account, but the only reason we want to do this is we want to use this for all of our banking use. So any money that goes through your banking system goes into this account and then back out. And the reason we do this is books and records. All right, step number three, what we're going to do is we're going to take a policy loan. It's going to be a loan against the death benefit. The loan comes from the insurance company and they just advance you part of your death benefit while collateralizing that loan using the cash value you've built up. We're going to use that to pay off the debts. And this also is used in velocity banking. We want to start with the lowest balance, not the highest balance, not the highest interest rate, the lowest balance. And then we want to go to the highest balance. Step number four, we're going to take the payments that we used to give away to those debts, the small debts we paid off, and we're going to recapture them through that segregated bank account that we set up, and we're going to put that money back into the policy as a loan repayment. You see, all we're doing is moving the money in a big circle. Let me show you. The money goes into the specially designed and engineered whole life. So these would be the premium deposits. Then what we're going to do is we're going to then take the loan from the policy using the cash value as collateral. And remember, the loan is just taking part of your death benefit. Then we're going to run that through that segregated bank account, and we're going to then pay off whatever debts we want. But if we paid off, let's just say a Visa, and you were giving Visa $100 a month, we want to recapture that $100 a month and move that money back through the segregated account. It's always going to stop there, and then pay off the loan balance. And in doing that, your money just continues to keep moving in a circle. But the one thing that didn't stop is the premiums you deposited in there never stopped earning interest and dividends, because the money you took out, the loan, wasn't your money leaving your account. The money you took out was the loan from the insurance company. All right, so step number five, what we want to now do is we want to make sure that we pay the interest to the insurance company, but this is only done one time per year. And we can do it using cash value, which I don't recommend, but some do, or we can just use it with leftover money that's in that segregated account. But we want to make sure we pay the interest on the policy loans every single year. Step number six, we want to repeat this until all your external debts, all your liabilities are completely paid off, and then all the money that you were paying to those external debtors is now ending up in your private bank. That is the infinite banking concept. I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put in new videos. You see, we're taught to buy cars one of four different ways, right? What are the four different ways we can buy cars? Let's go through them. Number one, you could take money out of your bank and you could pay cash for a car, which means you can exchange cash for the car. You can drive the car away, and the second you drive it off that new car lot, it depreciates and you lost 20, 30% of its value, right? We all know the routine. And buying a car cash, most people that you speak to, most wealth advisors, CPAs will tell you that that's a terrible way to buy a car, because you lost the earning potential and the opportunity of that money you had because you gave it to the dealership or the person selling the car in exchange for a car that's going to depreciate. cars are one of the fastest depreciating things out there because we use them every day. So that's a bad option. So option number 2 is lease the car, right? Leasing is relatively new. I remember the first vehicle I leased was I think it was a Chevy S10 ZR2. And that was my first lease, my first experience with leasing. And I did it because it reduced my payment. That's all I cared about, was the lower payment. I didn't care about the fact that I was just giving money to the dealership's finance company, and then at the end, they just took the car back. I wasn't focused on that. I just wanted the car now at a payment I could afford. So leasing, became part of my life, and I started leasing and using the third method. But we all know what leasing is. You exchange monthly payments for the right to drive the car based on the amount of mileage that you're allowed. And if you go over those mileage, God forbid, but if you don't, you got those mileage, you turn the car back in 3 years, and they give you another lease, and you keep repeating that cycle, and you're trapped forever. You're just always exchanging money. And that was, for some reason, folks, correct me if I'm wrong, but doesn't that payment always seem to go up when you're leasing? Like you're leasing a car at $200 a month, then the next car is $300 a month, the next car jumps to $500 a month, the next car is $700 a month. You get the drift. It just never seems like the payments stay the same. And we really never really upgrade too much on those cars. It's almost like a trap. So leasing is popular among business owners because our CPAs tell us, oh, you can write the full lease payment off. But then there's another option, right? Option number 3, you can finance the car. You can buy a car. You can take it to your local community bank, your local credit union. You can take it to your local bank, or you can just have the finance company at the dealership finance that vehicle for you. And they'll find a bank, and they'll take points and spread and all that stuff off of those loans. They make a bloody fortune on financing. And all we do then is we exchange monthly payments and a deposit in most cases, a deposit and monthly payments in exchange for the right to drive the car, own the car in 5 or 6 years, whenever that is. So that probably is the most logical way we buy cars. And that's the number one way that I've bought cars, that and leasing. Okay. But then there's the fourth way you can not buy cars, but get cars, is you could steal a car. You could. I mean, let's be honest. Hey, if you wanted a car bad enough, you could go steal the car. You'll probably go to jail. I'm not going to teach you how to steal cars. I'm going to show you how I learned to buy cars. And I learned it from someone by the name of Brent Kessler. Okay. And he showed me this, and my eyes went, I literally looked at that, and I'm just like, oh my God, there it is. The dollars and the idea hit me. I was so pumped about this because I'm like, I can get all the money back for all those Audis that I've been buying. And I didn't know about this before. That's where the story begins. So now what I'm going to show you, and I want to be clear about something. I want to be very transparent about something, is this system I'm going to show you doesn't mean that when I show this to you tomorrow, you're going to be able to go buy a car in this way. This system takes a little bit of time to capitalize, and you're going to see that. Not a lot of time. I'll show you my system. And it's funny too, because I had to actually, well, I'll get into that when I show you the slides, but I had to kind of take all my old plans, and I had to put them all together to show this the most accurate way. Not only that, I'm not going to just show you how I bought the cars. I'm going to show you what cars I actually bought. That's how much I love this. So there we go. Let's jump right into this thing. So I'm going to share my screen with you. So with that, here we go. We're going to dive right into this thing. So this is all about buying cars. I've already explained that. Okay. There's different ways to buy cars. There's different schools of thoughts for buying cars. This is simply a way that I've learned how to buy cars. It's a wealth hack, if you will. It's a secret of the wealthy on how it can be done, but it is so simple. It is so simple because it involves one change in your life. That's it. All you need to do what I'm doing is change one thing. And that one thing, we'll get into that, is where your money goes first. That's it. It's where your money goes first. You're already doing this, folks. You're already doing this. You're giving money away to somebody else every single month for your lease payments or your car payments right now. True or true? We are. You're already giving up money every single month for your cars. Some of you are giving up large chunks of money every 5 or 7 years to pay cash for a car. And some of you are giving up monthly payments to rent your car, commonly known as leasing. But we're all doing this. Okay. And the other thing that we're all doing is all of us have some method in our lives of saving money. So all of you are saving money somehow, some way. Think about it. Where's your money going? Okay. So you get your paycheck, it's netted out for taxes. Oh, and
net it out for taxes, and then you get your net paycheck, and then that net paycheck goes places. The car payment, the mortgage payment, the car insurance, all those things. But some of that money makes its way to a savings vehicle. You can see the evolution. We went from a $20,000 car to a $45,000 car to a $63,000 car during different periods of time in my life. The $63,000 car just happened at the end of last year, 2019, and that is my wife's car. It's not my vehicle, it's my wife's vehicle, okay? It was the car she wanted. I'm gonna talk about that as we go through it. So those are the three different cars that I bought. Now, this is how most people would do this. Now, we know that there's these different options to buy the car, throw out the stealing the cars, because we're not gonna go into that, but conventional financing. Getting into it, car number one, that was how it shook out. So I took a loan for $20,000. It was a 5-year loan at 5% APR. This isn't how I bought it, but this is just how I summed it up. So that was the vehicle, 20 grand, 5-year loan, 5% interest rate. The payments, $416 a month, $5,000 a year. Total amount you would pay in interest on a $20,000 car financed with a conventional bank over 5 years is $2,917. So that would be the first car. So what is the second car? The second car is that $45,000 Audi. 45 grand. If you finance that at a bank, a conventional bank, it would be a 5-year loan. Now, why does the interest rate change? Well, folks, this is real life. 2007, interest rates were higher than they were in 2012, correct? Think about that. 2012 was right after the Great Recession. The Fed dropped interest rates, so 3% was actually a pretty common thing to buy a used car and pay 3%. So I just want you to see a $45,000 loan for 5 years at 3% is $875 a month, $10,000. And also too, you can see right down at the bottom, folks, just to be full transparency, in case any of you grab these numbers, go to bankrate.com and you're like, Chris, those aren't the real numbers. Yes, they are. They're right off bankrate.com, but we included tax and title. Can you buy a $20,000 car and not pay tax on it? No, absolutely not. So folks, these numbers, these payments include the taxes on the car in New York State, which is, I believe, 8.25%, and registration of the vehicles. So I went all out. We didn't miss a beat on this. So that second car, if you finance that $45,000 car over the full 5-year period at a low interest rate of only 3%, you still gave the bank $3,806. $3,806. Now let's just do some quick math. I want you to understand this. Now that might not seem like a lot. You're like, actually, that's pretty good. The interest rate's really low. I would do that. 3,806 divided by 60 months. Folks, you're giving up $63 every single month in interest. Now that may not seem like a lot, but let's put all this together at the end. And folks, it adds up super quick. It was a 6-speed. Thank you, Adam. So that's the second car. What is the third car? It's my wife's SUV, which we'll get into the types of these cars, because this one is not an Audi, but it is an evolution of Audi, owned by the same company, but a little bit different. It is a Porsche. Okay. So the principal on this Porsche was $63,000. 5-year loan at 4.5% is $1,084. And actually there's a typo there. The one thing that you're seeing here, and I want to be clear because I know these things very well, this should be a 6-year loan, because a $63,000 car, most people are going to do a 6 or even a 7-year loan. So that shouldn't be a 5-year. It should be a 6-year loan. We'll change that slide. But right there, over 6 years, your payment would be $1,084, $13,000 a year. You just gave up $9,758. So now let's just do this. 9,758 divided by 72 months means you are paying $135 every single month in interest to somebody else for a vehicle that's going to depreciate. That's what I want you to start thinking about. It's not about the car payment. It's not about the car. It's about how much money you're giving away to everybody else. And we got to change that one thing. And that one thing will then allow us to put that money back into our banking system. The total interest that you had paid for these cars, 5 years, 10 years, and 16 years. So 16 years worth of car ownership, 3 cars, you gave up $16,481. $16,481 over 16 years. So 16 years divided by 12 months. Well, we're not even going to, it's not even important, but that's how much money you gave up to the banks. Okay. And what did you do with the cars? Well, you drove them. You used them. Some of them you crashed. Some of them you sold. You did different things, but it doesn't matter. The bank, without having to do anything, without having to work any harder, without having to really do anything other than make you a loan, made $16,000 off of you over that time frame. Sure, many of you are thinking, cost of doing business, Chris, cost of car ownership. Yes, until you learn this. Now, here's my way. So this is how we buy cars now. This is how Hannah buys her cars. This is how Brent buys his cars. This is how I buy my cars. This is how Adam's going to be buying his car. And this is how many of you are going to buy your cars. So watch closely. Now, in order to buy cars, okay, you have to, if you're going to pay cash for a car, you'd have to save that money. So back when I did this, and just so everybody knows, what we're looking at here is just a privatized banking system. Now, in 2007, I had banking policies, okay? They weren't like the ones I designed today, but they were still banking policies because I was in this business, so I had these. And what are these things? For those of you that don't know what we're talking about, what we're looking at here, these deposits, okay? I don't care if it's a bank account that you want to do them from, but I want to get uninterrupted compound interest. So what we're looking at here, and let me kind of get my little drawing tools out, okay? What we're going to kind of focus on is this deposit right here. 18,000, which is $1,500 a month, okay? 18,000 works out to be $1,500 a month. Where did that $1,500 a month that I was saving? Because it is a deposit account. So I was depositing the equivalent of $1,500 a month into a series of different banking policies. So what is a banking policy? Some of you might be asking. It is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Not the normal whole life like you would buy off the shelf at your life insurance store. These are built for banking. They're built to operate and work much like your conventional savings account does, okay? However, unless your savings account pays you a guaranteed 4% plus dividends every year, your bank account doesn't beat my bank account. Now, there's a downside to my bank account. So your bank account, actually, if you're using a conventional bank account, which most all of us have, including myself, if you're using a conventional bank account, if you go to the bank and you deposit $1,500, the first year you have access to $1,500 because you're probably not getting any interest, right? In my banking system, the one you're looking at here, in the first couple years, I don't have access to all of the money that I put in. But it's really okay because if you're saving money in a savings account, how many times do you make a deposit and take all the money out? How many times do you do that? Very rarely do you ever deposit money and take all the money out. So this account, I put in $18,000 in the very first year. Okay, after I put in $1,500 a month, I have access to roughly 61% of my money. Okay, $10,990. So that's how much money's in my savings account. So most of you would be like, yeah, but that's not 18,000. I'd rather put money in my bank account, my regular bank account. Okay, so if that's what you're thinking, great. But just stay with me because your regular bank account doesn't pay you uninterrupted compound interest. So I did this for 3 years. I put in 18,000 year one, 18,000 year two, and in the third year, as I was making those deposits, what I did is I took a $20,000 loan from my specially designed and engineered whole life policy. From here on out, for the rest of this training, I'm not going to call it a specially designed and engineered whole life because it doesn't just flow off the tongue. I'm going to call this a banking policy. Okay. Just like my bank account, this is a banking policy. So I took 20 grand out. And what did I do with that 20 grand? I bought a car. Now, I showed you in the prior slide, if I had gone to the bank and financed the car, I would have had to make monthly payments for that car. But what I did is I was just saving money every month. Okay. I just saved between multiple policies because this isn't just one policy. This is several policies. I basically had been putting money away into these different policies for many years. So I basically had put that 18 grand in. And at that point in time, I would have had, if you added these two numbers up, I would have had $40,603 in my account at the end of the third year. But somewhere in that third year, what I did is I took 20 grand out. Now, I want to be very clear because I'm just showing you how to buy cars. Here's the reason why I use these specially designed banking policies. You see, this $40,603 that I have in my account that is earning a guaranteed 4%. That's 4% interest is what I'm earning on that money right there on this $40,000. Sorry if it's a bit scratchy in terms of how it looks, but that $40,000 is earning 4% plus dividends. So the number I use for this policy is 6.2 because that's how much the dividend and the interest works out to be today. So my money in this plan is earning 6.2%. Now, dividends are not guaranteed. We are using non-guaranteed values here, but the dividends are what they are and what they have been. Matter of fact, they were lower back, or they were higher back then. So I'm just using today's numbers. So if I took 20 grand out, so if you had 40,000 in your bank account and it was earning 6.2%, you went in and you took 20,000 out, how much would you be earning interest on? Well, 20,603, right? That's how much interest you would be earning. You'd be earning interest 6.2 on this amount. But how much am I earning interest on? I'm earning interest on the 20,000 that I took plus the 20,000 that's in. So the full 40,603. So how can you do that? How can I earn interest on 40,000 when I just took 20,000 to buy a car? Well, this is where the magic starts. And I have another video that teaches that, but the insurance company gives me the ability to use their money. So I take a loan from the insurance company's general account, which they've got way more money than I do. And the insurance company just uses my $20,000 as collateral, but they agree to continue paying me interest and dividends on the full amount. They're agreeing to pay me interest and dividends on this full 40,000, even though I took 20 out. So that is key. That is very important as to why this way of buying cars works so well. You see, what happens is in the first couple of years, it's not going to make a huge difference. But over time, what you're going to see, I have a perpetual tailwind. What is that tailwind? It's something Albert Einstein called the eighth wonder of the world. Okay. Something that he said was the most powerful thing in the financial world, or the financial universe. It is called compound interest. But you see, what I'm doing is I'm earning uninterrupted compound interest because this money that I have never stopped earning interest, even though I took it out. So I just wanted to help you understand what's happening because I really just want to show the mechanism of how this buys cars. But you need to understand that there's always going to be interest and dividends paid on my full amount, not the amount minus the car purchase that I made. So if we do that and we basically look at these numbers, now that you understand kind of what's going on, I took 20 grand out, but now you see this $5,000 car loan payment? You're probably thinking to yourself, why would I have a car loan payment if I paid cash for the car? Well, because this is my bank, folks. This account that you're looking at, it's my bank. I treat my money the same way that I treat the bank's money. And when I borrow 20 grand from my local conventional bank, they don't just say, hey, Chris, you can have the 20 grand, don't pay us back. Do they? No, they say, here's 20 grand and here's the monthly payment of $500, or in this case, 416, I believe it is. You got to pay us 416 a month. So if I was okay paying 416 a month to their bank, why would I have a problem paying $416 to my bank? The $18,000 that I was saving every year was already money that I was saving already. It's not new money. It's not like I had to go find that money. It was money that was going into my savings already. It was automatically taken out into multiple policies. So the $5,000 you see on there is that $416 that I would have given to the bank if I took out a car loan. Now I just pay it to myself. And folks, this is the fun shit. Excuse my language, but paying yourself is way more fun than paying the bank. And here's why. You see this $5,000 every single year? Every single time I pay myself $416.16 to drive my car, I put $416 a month back into my account, okay? So that $416 goes back into my value. Every penny of that $416 is mine to use tomorrow when that check clears. How much more fun is paying $416 a month to yourself and getting to use it versus giving it away to someone else to drive the car? It's way more fun. And it works way better because, hey, when you become the bank, when you actually start taking back control of your money and stop giving it away is losing control. Taking back control is paying yourself. So I'm just paying myself every single month the same amount that I would have paid a conventional bank to buy this car. So what is the outcome? So what happens? So I've been putting $18,000 into this savings program, right? And it's not 18 all at once. You know, you could do it all at once. I did it monthly, which worked out to be $1,500. It was actually several accounts. So I did about $500. Okay, let's just round it and make it easy. $500 a month into 3 different accounts. And that was okay for me to do. I could afford to do that. Okay. And even though back when I did this car, I didn't have a ton of money, but I was still able to save. I've always been a good saver, and all of you should be as well. So what happens now is, as we kind of move through this, you'll see we have put some money into our account. So how much money do we put into our account? I got to get my clicker to work. There we go. So over 7 years. So the first 2 years, I had to capitalize my account. So if you were looking to buy a car tomorrow or this year, you would have to pre-capitalize your account. You would have to dump money into your account all at once to get it ready to buy a car. And people do this all the time. But the way I did it is I just put money in every single month, and I saved up. And when I had enough money to buy that car, I actually had more than enough money. I took 20 grand out and I used it to buy this car. And so over 7 years, the first 2 were just capitalizing. The other years were just me contributing and depositing money in my savings. I put a full $127,000 away over a 7-year period of time. It seems like a lot of money, but folks, when you break it down, it's really not. It's what all of us are probably putting somewhere else anyway. Then how much money did I pay back to myself? $5,000 a year. Okay, $416 a month for that car payment, but the car payment got paid back to myself, so that was $25,000. So $126 plus $25,000 was $151,000. So into my banking system, I deposited, with the deposits and the car loan repayments, $151,000. There's the car. It is I don't remember what year that was, but it was a Audi, and actually that was an Audi A8. It was a several-year-old Audi A8. I don't remember, how many year old it was, but it was a $20,000 car. Had lots of miles. You see, one of the things I always did with my Audis, I wanted the nice one. That's a beautiful car. But that car had well over 100,000 miles. Otherwise, I couldn't have got that car for 20 grand. So I only wanted to have the car for a period of 5 years. The thing broke down all the time, but that's beside the question. Let's see, pay it back monthly to yourself, your banking policy. Correct. So I've got some questions, and let me just take a moment and in a second, and I'll answer your questions. I just want to finish my thought, and then we'll explain it. So I put $151,000 into my banking system, $126 in deposits over 7 years, $5,000 a year, or $416 a month, because everything is monthly, $25,000 for that car. So over 5 years, I paid $2,000 or $20,000 for the car, but with financing, it cost me roughly $25,000. I rounded up. So, but then out of that $25,000, what else happened? I had to buy the car, didn't I? So out of the money I put in there, the 151, I took 20 grand out and I bought the car. Therefore, my net injection into my banking system, which is the deposits I was making just on a regular basis, okay, for no apparent reason, I was just saving money for the future. That was the 151 plus the car payments, okay, which was the $5,000 a year, minus the car was 20 grand. I put a net injection of 131 into this banking system. And during this period of time, I drove that beautiful car right there. Okay, that was at my house out on Cherry Street in Lockport, New York. That driveway right there was filled with these little Audis because that was my little bad habit. But this car, the cash value growth after the purchase of this car. So now let's look at the cash value. Let's focus just on this column here, cash value. After 7 years, how much money do I have in my bank account? $116,343. $116,343 is in my account. So how much did I put in? 131. How much do I have? 116. So I literally, for that car you're looking at, this is the very first car I bought with this system. That car, that Audi A8, whatever year that was, I got 89 cents back for every single dollar I paid for that car. And I still, you got to remember, after the end of this, I got 89 cents back for the car, but I still owned the car. A lot of people confuse that and say, well, wait a second. Yeah, you got 89 cents because you sold the car. No, no, no. The car was in my driveway. I just got 89 cents back for every dollar I paid for it. Now, let me ask all of you a question. How many of you have ever bought a car, had the car for 5 years, and then had 89 cents back for every dollar you paid for that car, plus the car was still in your driveway? Well, very few people, unless you're a car collector or you're somebody that buys cars and renovate or fixes them up and like gets the equity back. Most all of you have never actually even known how to get 89 cents back for every single car you've ever bought, driven, and owned. So that's not too bad. But here's the problem. That's not 100%, is it? I said, I'm going to show you how to get every dollar back for every single car you buy, drive, and own. And now we're going to go on to car number 2, but let's come over here and just hit a couple of questions real quick. So first, when and how do you have to repay the $20,000 back you took out of your policy for the car? So that's a good question. And I did answer that, David, but that's okay, because a lot of people probably have that question, but they maybe haven't yet gotten to the conclusion of that. So remember, this $416 a month that I'm giving to my banking policy, I'm taking that $416 every single month and I'm depositing it back into my account. I'm repaying this loan that I took from the insurance company. But when I repay the loan, my value goes back up. The access to my capital goes back up. So all I'm doing is I'm just repaying myself the exact same way I would repay a car loan with the conventional bank, dollar for dollar, same terms, same monthly payment. Nothing changes with what you do right now when you buy cars if you're financing your cars. Exact same strategy. If we were trying to set up a college savings plan for a child, well, we'd normally contact an advisor like Mr. Naugle when I was an advisor, okay? And we would say, all right, hey, I want to set up a college savings plan. What do you got? I'd pull out a bunch of fancy brochures with some average rates of return on them. Don't get me started on the rate of return. And I would then start showing you all these different accounts called 529s, UGMAs, UTMAs, College Sense, college planning, all these different things. All of these vehicles makes it so that I would have to then give the money over to that account and give the money there. They are then in control of the money, fees on that money because it's some type of investment or CD or something, but there's fees in one way or the other. And then I have to just leave that money and it just sits there until Viviana goes to school 17 years later. And if I want that money back out of almost all of those accounts, what happens? I get some type of penalty. I have to pay some type of tax on it. It's a one-way street, okay? I can go down the street, but I can't go the other way on it. Otherwise, I have to pay the price. This account right here is nothing more than what I'm doing for Vivi's college. But you see, this account works very different. I can put the money in, I can take the money out. There is no one-way street. This is a fast-moving, 2-lane superhighway that when I put the money in, I can take the money right back out. So here it is. I'm not going to get too deep into the numbers, but here's my first 5 years. Now, remember I said your money's got to be moving like a river. So if I just put 10 grand in there and I just leave it, which is what this shows, I'm not making my money work for me, am I? I'm just putting my money and leaving it in that stagnant pond. But my stagnant pond actually is a little bit better. I got a little spring, okay, in the middle of my stagnant pond, gives a little bit of oxygen. So it's not quite black. It's still nasty, lots of algae, but at least I got a spring because I'm beating inflation. But I'm not going to leave that money there. No way. I put 10 grand in. This is what's called a Mass Mutual HEC fee. Okay. It's not the right plan for everybody. And pretty soon I'm going to have one of the most incredible trainings you have ever seen on IBC. And it's actually going to be a live training with a real client, walking them through the entire process and how we work with our clients. Many of you are clients, and we're going to show you how we work with you, how we solve your problems. We're going to show you how we do the plan designs. This is one of the 4 plan designs that we do. And then how that plan design then goes to our mapping team, how we do the mapping, how we do the tools, which is the Cashflow tool. And then at the end, it shows which one of these designs solves your problem the most efficient way. Isn't that the way everything should be? Start with the problem. Okay. Start with what it is you want. Then figure out how do we solve that problem and what is the best design. So in order to do that, there's not one way to solve a problem. There's many ways. We got to find the best way. Okay. So that's why there's so many tools out there to fix things, because there's not one tool that's the best. There's lots of different tools, and each one does something a little differently and a little bit better, some worse than others. Then after we figure the tool out and we got our design, then we need to see which one of these tools works the best for your particular situation. That's what the cash flow and the mapping does. We're going to walk you through that entire training. But here, what you're looking at is just my plan over 5 years. I put 10 grand in and I can take 9,200 out in the first year. I put another 10 grand in, I got 19 grand in there. If I didn't take any money out the first year, I'd have 19 the second year. And then I keep going and I do that. But really, if we did the math on this, let's just do year 3. So so you guys understand, I want to teach you something, and many of you have seen this already, but if I just want to figure out how much money do I make, what is the cash flow? I would take third year, 29,433, and then I would subtract the prior year. Okay. That would tell me my cash flow. So subtract 19,090. Whoops. Shoot. I got to redo that. Fat fingers. 433 minus darn it, 29,433 minus $19,090. That means I made 10,343. But that year, the second year to the third year, I put in 10 grand. So I got to subtract what I put in. I mean, that's my new deposit. So I made $343 from year 2 to year 3. So right here, I could write 343. That's how much money I made. Now that doesn't seem like a lot, but if I divide 343 into 10,000 bucks, I made 3.4%. Did I beat inflation? Yep. Did I have full control of my money? Yep, because I could have taken that out and I could have taken that out, and I still would have made the same interest rate. But let's keep going. Let's do fifth year. Okay, fifth year, I got 51,126. 51,126. Subtract the prior year. So if I take year 5 minus year 4, which is 40,055. Whoa. I just made 11,071. Subtract out that $10,000 that I deposited that year. So you can see here, year 4, I deposited 10 grand. So I subtract that out. Now, a very short period of time later, I now made $1,071 on my 10. You see, this is what uninterrupted compound interest looks like. I'm just trying to show this to you. I know I got a lot of things on the screen, but I take 1,071 and I divide that into that year's deposit, 10 grand. Holy smokes, I just made, you guys could have done the math, I made 10.71, I made 10.7%. Sorry, it's hard to see because I'm using red when I should be using a different color, but I literally just made 10.7%. Is that more than inflation? Darn right. Now I'm moving in the right direction. And it doesn't matter what direction I go. If I keep doing these numbers, if I keep going down, the numbers keep going up. They don't ever go any other direction but up. Wouldn't that be a really good thing? But now, that's all good and great, but hold on. I already said that your money's got to be moving. Your money right here, what I just showed you with those returns that you were getting all happy about, that's your money not moving. You haven't done anything with your money. I would be mad at you. If you were my client and this was you, so I'm talking to myself, and all I did is park my money here and let it sit in that stagnant pond because it had a little spring. I'm like, well, it's got a spring, man. I'm beating inflation. Who cares? Wouldn't you want to make more? Yeah. Well, to make more, what do I got to do? Move, right? Move that money. That's all we got to do. So let's move it. Let's show you. So here's just those returns I already showed you. So 5 years was, 10.7, 11 years, 96%. Cash on cash, true numbers. If we went down to the 10th year and we went year 11 to year 10. So if I subtract 117,559, okay, and I'm just going to, let me get my pen out, get a different color here. So if I take 117,559 and I subtract the year before, which is 109. So year 10 from year 11. Okay. What that would give me is that would basically give me a number. And then if I subtract out I deposited that year, that would give me 3842. That's how much money I made. So I deposited now I want you guys to understand this. This is kind of important. This is only 10 years down the line. I put $4 grand in and I had 3842 to take out. I put 4 in and I made 3842. I didn't put 4 in and only have 3842. No. You're missing the math there. If you did the math, I put 4 in, I can take my 4 back out and an additional 3842, which is a 96% cash on cash return. Is this how your money works now? Is your money doing that? If it is, great. I'm happy for you. It should be doing this. This is what we should be taught to do with our money. But then comes the next question is, how do we move that money? Well, I had to, folks. Sorry. That's Viviana. Just so everybody knows, this is the first 18 years of her life, the financial planning that I'm doing, the financial plan that I'm setting up for Viviana. And, we always ask, what is your why? What is your why? Well, that's my why. So Jan said, don't you just need to divide the total deposit, not just the 10,000? Yeah, you could do it that way. I did it the long way, Jan. I just sort of showed, I wanted people to get in the habit of taking the 1 year minus the other year. Then you subtract out the amount of your deposit and you divide that in. So you're correct. So she's just doing the math a little differently, I believe, is how she's saying that. But yeah, so that would be how you do it. So there's Viviana. That's my why now. Here is the first 18 years of me using this plan. Hypothetically, this is how I would use it. So how would I use this plan? Now, I also want you to focus on something, folks. I'm only going to give you the guaranteed numbers. Before I gave you the numbers with the dividend, but now I'm only giving you the guaranteed numbers. So these numbers are going to be less than what you were seeing before because I'm not showing you the dividend. So guaranteed numbers only, okay, which is 4%. So here's what I do. I put 10 in. I have a guaranteed 92.57 I can take out the first year. But let's just say first year I don't have anything to use that 9,200 for, which most of you would, but I don't. Second year, I put almost 10 grand in. I put 9,950 in, okay? And I have $19,077 in there, guaranteed. But I don't have anything to use for it. But then year three, I put another 9,950 in. And now what do? Well, my buddy, who's a real estate investor, gives me a call and says, hey, I need to take a loan for a property. I need to fund the renovations. And I say, great. I'm going to charge you 12% interest. And he says, okay, perfect. And then I'm going to take security of a lien on your property. So now it's a securitized loan. So there we go. We got 12% that I'm charging on this 25 grand. And then what I do is I basically loan that money out for 2 years. So I take 25 grand here. I loan it out for 2 years. But the first year I take 5 grand. I pay it back. The second year I take 20 grand when he gives me the final balance. I've repaid the plan back to 25 grand. But what you're not seeing is the interest that I just made there. Now, what is 12% on that? So I've done the math. 12% over 12 months, or 12% on 25 grand is $3,000 a year. $250 every single month. So this loan is literally paying me $250 a month. Now, what I'm not showing you is I'm not showing you that $250 going back into the plan. That's right. I'm not showing that $250 going back in the plan. I'm just showing me keeping $250 a month each year. So that means over the 2 years that I had this loan out, hypothetically showing what I just did, how much money did I make at the end in interest? Well, I made $6,000. Now, what did I do with that 6 grand? I blew it. I did. I just went out and I blew it. I didn't put it back in the plan like I should have. I just went out and I blew that money. That's all I did. Okay. It was an extra $250 a month. I don't know. I went out and I spent it. Darn. How much money did I make over here? The same amount I just showed you. Those returns that I showed you a second ago in those first 5 years, I made the exact same interest rate is what you saw before, even though I took the money out. But now I got an extra $250 a month to go out and do whatever I want with. So Jan said, so the return would be much less wise. It should be based on the total. Oh, Jan. Okay, hold on. I got to answer this, folks. We got to go backwards here. Let me do this, Jan, because it's very important. Jan is doing what every other person does, and I missed an important step here. I didn't miss a step. It's just this is what you're taught. So hold on. Let me go backwards. Come on. All right. So what Jan is doing, and I do have this in this presentation, Jan, but I want you to understand this. What Jan is doing is Jan is not understanding the difference between cash on cash return, which is the year over year. How much money did I make just this year on the 10,000 I deposited? How much money did I make just this year on the 10,000? What Jan is doing is what's called cumulative return. She's saying, okay, over 3 years, I put in $30,000. I believe, Jan, correct me if I'm wrong in what I'm saying, but that's just what I took from what you said. I'm put in 30 grand and I only have, where's my cash value? Total cash value. I have 10, 20. Sorry, I'm doing my math wrong. I put in 60 grand. Sorry, not looking at the numbers, folks. Let me go back one more screen. It's easier for me. Yeah, man. I hate going backwards. Come on. There we go. So what Jan was doing is the cumulative return, which means, and this is what you mostly do. So cumulative return is not how you're going to calculate return using these vehicles. Cumulative return is what you've been taught to do because what have you been taught to do with your money? Give up control and leave it sit somewhere to earn returns, right? Give up control, let it sit there and let it earn a return, which is what Jan was talking about. So if we took this money, if we put in 50 grand over 5 years, okay, this is cumulative, and we have 51,000. Okay, that means we made a net of 1,100. I'm just trying to do this, 26. So this is what Jan, and we can do this for any year. I'm just picking the 5th year. So that right there means you would take 1,126 divided into the 50,000 that we put into the plan. I made only, oh, that sucks, Jan. I only made 2.2% on my money. Actually, 2.3. So if that's how you're doing the math, that's because that's what you've been taught to do. But does cumulative return, is that what works for what we do here? No, because remember, every single year, If I have 9,200, I'm going to take that money out and I'm going to go earn 10% on that money. Okay. I'm going to loan that out. The second year, you know, whatever that is, let's just say it's 9,800. I'm going to take that money out and I'm going to go earn 5% because I'm going to pay off a credit card or a loan. Okay. The next year, how much do I have? I put in 10, I have 10,300. So I'm going to take that 10,300. I'm going to take that out and I'm going to loan that to my buddy at 12% in a private loan. Okay. The next year, I don't know what that is, 4 down 3. So let's just call it 10,100. It's more than that, 40 minus 29, whatever that is, but whatever. I'm going to take that amount. Let's just call it, let's call it 11 grand. Okay. I'm going to take that out and I'm going to go out and earn 3%. I'm going to pay off a low interest rate credit card. And then the final year, I've got 11,000. I put 10 in and I got 11 and I go out and I'm going to earn 12 on that because I'm going to loan it back to that same guy for that another flip. So each one of these years, how much am I making each year? I'm making, as it's showing here in 2020, my 10 grand the first year is earning an interest rate of 4% plus a dividend of 2.2 in this plan. So I'm earning 6.2. How much am I earning the next year on 20,000? Even though I took it all out, okay? I took 19,000 out. It's gone. It's gone. It's out there making, my first 9,200 is making 10%. My second 9,800 is earning 5%. My third 10,000 and change is earning 12%. My fourth 11,000 is earning 3%. My fifth year, and again, all I'm doing is I'm putting money in and I'm taking it out. Okay, that's why cash on cash return is what I'm talking about here. So what Jan said is, what about the cost to borrow money for the plan? I'm glad you brought that up. See, I have all this figured out. Jan's just getting way ahead of me here. The cost to borrow money is 5% simple interest. Okay. So what was the return? I can't remember what it was here, but whatever the return was, if you're earning 6.2 on the money, what is your net? Okay. 6.2 minus 5 is 1.2. Okay. That's the spread. So how much did I make? Well, I made 6.2, but by taking all that money, I had to give the insurance company 5. So I made 1.2. Now let me ask every single one of you a question. How many of you would be okay making 1.2% on your money that is no longer in your account? Literally, the money's not in your account anymore. You took it out. You put 10 grand in and you took out 9,200. You put 10 grand in the second year, you took out 9,800. You put 10 grand in the third year, you took out more than 10 grand. And you're still making 1.2 the first year. But you see, that's just the first year. So what about year 5? What was our return there? 10.7. Okay. So 10.7 was our cash on cash return minus the 5%. Okay. What is our return? Oh, 5.7 if I'm doing my math right. 5.7, is that right? So I made 5.7% net. 5% is gone. The insurance company, you got to understand, 5% is gone. The insurance company is charging you interest on those loans that you're taking out of 5%. But we already know that the insurance company is charging 5%, which is why I'm doing cash on cash return each year, because each year you're seeing the impact of exactly how much money your money's making each year or how much money you're losing. So year 1, even if you're making 6.2 over here on your money and you're paying, so if you took that money out, here you took it out, that means now you got to pay the insurance company 5%. So you take 6.2 minus the 5, okay? And there's also a cost for this insurance. So you got a death benefit over here. If I die, Viviana is going to get $435,000. There's a cost for that. And I don't know what that is. That's why I'm netting the numbers out. All these numbers I'm showing you are net of all of the cost in the plan. It's the only way I can show it. So if I lose 5 here, but then how much did I say I was making on that 9,214? Was it 10%? So now I make 10% over here because I'm using that money. So I made a spread of 1.2, okay, taking the 5 out, and then I make 10 over here on the money. So the first year is the worst year, no matter how you do it. But I'm just trying to help you guys understand. Jan is trying to, understand what I'm saying, and I just didn't get there yet. I have a slide for it, but I just kind of going backwards, Jan, just to help you understand this, because I truly want you to understand how this works every step of the way. I want you to understand all the fees. We did another webinar where that's all we did is talk about all the negatives with this, all the negatives. But I don't care how many negatives you throw at me. Like, I love when people question this because there's an answer and I want to get that out. So if you're earning 6.2 on this side, and to take and borrow your money, it costs you 5, but this 6.2 is compounding every year. So year 1, you're earning 6.2 on 10 with the dividend. That's assuming the dividends don't change next year. So the next year you put another 10 in, now you got 20 grand in there. You're earning, if dividends don't change, 6.2 on the 20. Third year, 30. Fourth year, 40. Fifth year, 50. you're earning this, well, let's just call it the 4%, which is what I'm doing on Vivi's. You're earning the 4% guaranteed on the full 50. How much money is there in your account? Well, it's all in there. Actually, all 51,000 is there, but how much is actually out being used and making money? 51,000. That's what I mean. It's a raging river. Your money's got to be moving. We're constant. When we put money in, we want to have a place to take it out. Pay off Visa. Okay. When you got 19, when you take the next 10, okay, you take that out, you pay off Amex. And all you do, whatever you were paying Visa, you take that money, you put it back in the plan, or put it in a segregated account, or, you know, loan that money out and blow it like I show with Vivi's. But all you're doing is you're just moving money in, you're putting it in, you're depositing it, and you're taking it out. Putting it in, taking it out. Is there money that the insurance company is charging you? Yes, it's 5% right now, 5%. So the insurance company's making 5%. They're tickled pink, man. They're so damn happy to give you money at 5% that they just, like, it's a big line item for them. So the insurance company's certainly charging. The insurance company's making money here on the death benefit. They're making money here on this, and they're charging you a $50 policy service fee per year. Okay, that's all the fees. You got a cost of insurance, $50 policy service fee, and interest rate on the loans. Great. Now all that's out of the way, right? We got all the bad stuff out of the way. These numbers I just gave you, folks, already takes all those into consideration. So is cost really an issue in this? A lot of people want to try to make it an issue, but cost is only an issue in the absence of value. Did I not just show you the value? So Natalie's saying, is the 5% locked in? No, it is variable. So the 5% interest the insurance company charges is variable, but I've been in this business since 2003. At New York Life in 2003, the interest rate we used to charge on the loans was 5.25. How much is it today? 5. That's how much it's fluctuated. They don't change the interest rates a lot, but can they? Yes, they can. It's very important to know that interest rate the insurance company charges is variable. The dividend that the insurance company pays, currently 2.2 for this company here, is not guaranteed. What is guaranteed is the 4%. Okay. And I will also say one other thing about the dividends. Today's dividends for this company and many of the other companies that we deal with are at 30-year lows. Go back in history and look at what the dividend was last year, the year before, the year before, the year before, 10 years ago, 20 years ago, higher than it is today. I like saying that because, hey, we're looking at worst case scenario or potentially worse. They could go down next week, but hey, who knows? Or I'm sorry, not next week, next year. They could go down, but all I can tell you is they are right now the lowest that they've been in 30 years. So let's see, Jan's still going. Jan said, how can they pay 6.2, 4% guaranteed plus 2.2 and charge you 5% and make any money? Oh, Jan, I'm not going to answer that one because that's kind of just there. But I will say, here's your sign. But they absolutely, I'm joking with you, Jan, just messing with you, trying to have some fun. They absolutely are making money. Insurance companies basically print money. And I showed you they're making the 6.2 that they're paying you over here on your money. Remember, that's because of smart investments that they've done for hundreds of years. They've taken your money and everybody else's money and their own surplus money and gone out and bought treasuries 30 years ago that were paying double-digit returns. And they're still riding the co-trains on that. They own real estate. They loan money out. Like they're one of the biggest lenders. Insurance companies know how to make money better than any financial institution that there is. You don't believe me? Look it up. But anyway, I got to keep moving on, Jan, and I love that you're participating and I love that you're doing, and I hope that that helps everybody because you know what? Sometimes we got to stop, pause, and just get all that nonsense out of the way. Let's talk about all the bad, but it doesn't matter how many bad things we try to talk about. I'm telling you, we can just talk all bad. We've done this in a live and in training. We did a whole 2-hour-long training, me and Brent, all about the negatives. And you know what we couldn't do? We couldn't find that. We found all the negatives, but we couldn't make them make sense. It still always made sense and worked. So let's go on to this plan here. So now all I'm trying to do here is trying to show you how I'm actually moving the money and how much I'm making. So remember here, I made $6,000. That's just on what I made on the money. Okay. That's not how much money my plan made. My plan made exactly what I just showed you it was making. So you can do the math there. I'm just making an extra $6,000 by lending this money out. Okay. Then I get all the money back. I'm just going to pick on Chris Rude because he's one of the people that I lend money to, and he's open with me saying that. Then Chris Rude finds another deal 2 years later, and he's like, I need $40,000. So I take $40,000 from my plan. I loan it out at 12%. How much money do I make on $40,000 at 12%? $4,800 a year. So $4,800 a year is what I'm making there per year. Now, do I show any of that 4,800 going back in the plan? Nope. Larissa went out and blew it. Okay. She blew it on all toys for Viviana and trips to Disneyland and whatever. $400 every single month extra just coming through the door, and my money. What direction is this? Even though I took all this money out, what is my number going down? No, just keeps on going up, doesn't it? So I took the money out. What keeps on going up? Well, yeah, because I'm paying it back. I take the $7,000, I put it back in. The next year I put the remaining balance, 33,000 back in. My number just keeps going up, but then I still earned uninterrupted compound interest on every penny of this money the entire time. You got to remember, every penny of every single deposit that I make is earning interest, even when all this money is out there working for me. So that was that, 4,800 there. But I'm not done. Remember, I got to keep this money working. Chris pays me all the money back. And I loan him 60 grand. How much do I make on 60 grand? $7,200 per year. See what I'm doing? Every year I'm getting a freaking raise. Every year the money I'm making off of this dumb, stupid, specially designed whole life just keeps on making me more money. I know, Leo, I'm not blaming Larissa. Just saying she'd probably be the one to, I came home the other day. I just got to tell you a little story about Larissa. God bless her. So our neighbors aren't really always the nicest people. He's awesome. She sucks. Plain and simple. If she's on here, screw you. Hurry up and get out of our neighborhood. It's terrible. Like, that's one of those bad neighbors, right? So Larissa, I come home one day and she's like, I'm going to get a quote on a fence. I'm like, great, get a quote. I came home and I see the contract. She bought a fence. So believe me, Leo, my wife knows how to spend money. Now, is it a valiant thing she's spending money on? Yeah, we're blocking the neighbor out. We don't want their dog in our backyard. We don't want them in our backyard. Matter of fact, I don't ever want to see her again. I like him, but I don't ever want to see her again. We all have neighbor problems. We all have our own problems. How do you solve the problem? You build a fence. That's what I did. Okay, here we go. Now we're 9 years into the plan, only 9 years. Every single year, except for the first 2 years, and I could have used the money, but every single year I got my money out there working. My little marching dollars are out there earning me more money, and all I'm doing is I'm taking the money out, and then I'm putting the money back in. Taking the money out, putting the money back in. I'm recycling and recapturing the money as I do this. Is there any more money that I'm spending here outside of the original $10,000 a year that I decided to do? No, for the first 10 years, all I'm doing is putting my 10,000 in. But how much more money am I making? Well, the first 2 years, right here with this loan, I made, 6,000. The next 2 years, it was, 10,200 or 10,600, the 4,800. Then the next 2 years, 7,200 a year. So that's 14,400. Okay. And then here we are, 80 on 80 grand at 12%, I make 9,600. So that's 9,600 this year, 9,600 this year. But I don't do that. I don't keep that money. Remember, Larissa's spending that. She's buying fences. She's buying toys for Viviana, doing whatever, planning trips. She's spending this $800. But you know what? That loan is getting paid back over here. So that's what I do the first 10 years in this plan. I could keep going. I just wanted to kind of show you how that would work. Now, what else could I do? Well, if Larissa wasn't blowing the money or I wasn't spending the money, could I have taken that $250 a month that I made from that private loan and taken that money and put it back in the plan? Sure. These numbers would do what? Just go back up. Wouldn't that just mean that I had more than 40 grand to lend the next year? Darn right. I would make a lot more money because I'd have the 6,000 here or 60,000 plus the 4,800 I made the prior 2 years plus the 3,000 I made the prior 2 years before that, all on top of that. Could I have just rolled it back in? Yeah. But I'm just showing the money. I'm just showing me making money and using that money to live on. Because, hey, look, I can teach you how to be really good with money, but you also have to enjoy your life. And, wouldn't it be nice to make an extra $250 for just having your money move every month? Wouldn't it be nice to make an extra $400 a month right here every month? You're not working any harder for that money, folks. That's just your money working for you. Is there risk with that? Yeah. If Chris doesn't pay me back, there's risk, but then I just take his property. Okay. Down here, $800 a month. Am I working any harder for that? Do I have to work more hours? Do I have to stay later? Do I have to put in overtime to make that extra $800 a month? No, folks, that's just my money working for me, but my money's working twice as hard because remember, this income right here is just what I'm making off of the loans that I took from the policy. Remember, the policy on every penny that's in here is still making that 4% guaranteed plus the dividend. As of 2020, the dividend on this company, Mass Mutual, is 2.2%. Getting in the weeds a little there. All right, so you guys understand that. Now let's keep going. Got more where that came from. All right. So now we're going to go to the next year, college. So now we get to Viviana's college. She's got I'm 61, which is frightening. So 17 years old, she goes to college. We got to pay for it. So how much do I have? Well, I got 174 in age 17, 185 age 18, and 197 age 19. So what does that mean? Well, right here, I take out each year. And remember, I'm only dealing, so I want to be clear about this because I'm kind of talking about dividends, but I want you to understand these numbers I'm showing, these are the guaranteed numbers. When we ran this, these are the guaranteed numbers, the cumulative guaranteed, which is only the 4%. I discount the dividend. It's not in there, okay? Because I just wanted to show you both ways. So Vivi goes to college, year 17. I take out 40 grand. I pay for her college. And then what do? Well, if I took a loan for college for Viviana, either she's got to pay it back or I got to pay it back. So what are we going to do? Well, we're going to repay that loan. 20 grand. 20 grand, 20 grand. These are just me being an honest banker and paying the money back to my policy. The next year, I take 40 out, I repay 20. Next year, I take 40 out, I repay 20. Next year, I take 40 out. So what is that? So that's $160,000 for college. $160,000 I just spent to have Vivi go to a really good school. And I'm sure college will be more than 40 grand then, but we'll just take more money out, okay? Because you can take more, you can see it here. And then all I do is each year, I just repay myself the amount that I would normally repay a bank or a financial institution or the FAFSA loans or all the financial aids and all the student loans that I hear about every single day. All I'm doing is I'm just repaying that money. And you know what I just did? By doing what I just showed you, I literally got all the money back for college that Vivi went to. I literally got all the money back because all I did is I was an honest banker. I just repaid myself. But all it was is this stupid plan that I started back, 17 years ago for Viviana, putting $10,000 away per year. And then after the 11th year, I could only put in $4,000. So it started at 10, but now after the 11th year, it's only 4 because of the IRS MEC 7 pay rules. So all I'm doing is I'm just, again, showing money out, money in. So Viviana goes to school. But what else is really cool about this? This is if she goes to college. What if Vivi decides not to go to college? What if she decides to chase her dreams somewhere else, do something else, not go to college? If she decides not to go to college, what can I use this money for? I don't know. 130 grand will pay for her to go on a surf excursion trying to be a pro surfer. Oh, that fails. Great. Next year, 140 grand. We basically got that money. Whatever it is, whatever year she needs money, that money is there and she can use it for anything she wants. Unlike a 529 that you got to use for college. And if it's a state-run 529 because you wanted that state tax deduction, you can only go to school at that particular state college institutions. Nothing wrong with that. I'm just saying there's restrictions. Here, there's no restrictions. Whatever she needs the money for, we have the money there for her. And the money just keeps on growing. You see that? Just keeps on going up. Every year, it just keeps on going up. And these are the guaranteed. I wish I would have done this with the dividends. So now let's just keep going on beyond this. Okay, next. I retire. Okay, so I actually then decide that I want to live my perfect day every single day. So what do? I go back to this plan that I set up for Vivi's college. And what do? I look at the numbers and I say, okay, at 63, how much money can I take out? Well, I look at each year, how much money my cash value additions grow, and I look at how much cash I have in the plan. And here's my returns, cash on cash. So each year, that would signify how much money I can take. Now, this is just a supplemental retirement. This is just one tiny little plan that I put 10 grand a year into. Hardly my sole retirement, but let's just look. So from 63 to 64, if all I want to do is just take just the interest out of the plan, it's 224, 181 minus 210, 375. That's 13,806. But I had to put 4 grand in. So that's $9,806. So the reason I did that is $9,806 isn't going to get anyone excited, but that's me just stripping just the return I made that year. So in other words, I put 4 grand in, and that 4 grand with compound interest made me $9,806. So I deposit 4 and I take out 9606 or 9806. Could I take out the 9806 plus the 4 grand? Darn right. I put the 4 grand in, I can take the 4 grand out. So 4 grand plus 9806. Okay, that's 13,000. So if I wanted to just take my deposit plus my interest out, that's 13,000 divided by 12. That's an extra $1,150 a month, more than some Social Security payments. And all I'm doing is I'm just taking the gravy off the top. That's all I'm doing here. Not taking the full amount. I didn't even touch the principal. I just took what it gained. And each year that thing goes up. Here's my returns. I don't know many retirement plans that are going to be paying to those kind of returns because they don't have the perpetual tailwind, which is the uninterrupted compound interest that has been happening in this case in this right here for 20 years. I've been earning uninterrupted compound interest every single day of every single month of every single year for 20 years. Hence why I can make those kind of returns. It's not trick math here, folks. It just looks too good to be true, but all it is just math. It's the same math Albert Einstein describes as the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it. Pick a side. That's what he says. It's Albert Einstein. Read it. Okay, let's keep going here. Here we go. Now, oops, actually this one, yeah, here we go. So age 65, what I'm doing here is I'm doing it different. Let's say I didn't want to just take out that little bit of interest that I just showed you. Let's say I actually wanted to take out a sizable amount to retire. Anyone looking at this? Now, folks, this is very important to see. This is probably my favorite slide. And I'm going to change the color just because I'm so pumped up about this. So I want you to really look at this and I want you to understand what we're looking at here. So I am now 65 years old. Okay. I have put money into this plan now for 23 years, 10,000 for the first 10 years, 4,000 every year thereafter. I'm only looking at guaranteed values. I got 173,000 in there. What do? I take 60,000 bucks. Now in the first couple of years, just because it's early, I'm going to show repayments. Probably because I'm really just continuing to repay that money for the college, but I'm just showing 20 grand being repaid. But see that? After I put that in there, which actually in the illustration, I probably should have just got rid of that, but it's there. I don't put any more repayments because now I'm done. I don't want to repay any more money. I just want to enjoy my life and I just want to take income. So I take 60, 60, 60. Folks, also, this is all tax-free, just so you know, because all I'm doing is I'm taking money from my death benefit. Every one of these loans reduces my death benefit. But my death benefit also is growing. So you don't really, it doesn't look like it's going down, but it really would be going up even more if I wasn't doing this. I take loans and loans and loans and loans over the course till I'm 84 when I die. Dying probably was a surfing accident in 84 or maybe, snowboarding accident. I've taken out $1.5 million. Okay. 1.5 million. And I put in 227. Now I want you to just remember this plan that you're looking at here. It funded private deals for investors. Those deals could have been mine too, but I show them just as private investor deals. It funded Vivi's college and whatever else she needed. Then it funded my retirement as shown right here, 60,000 a year. I took out 1.565 million tax-free. I only put in 227,550. These are guaranteed numbers, so I can use the big G word. Folks, this is how this works. This is the power of using privatized banking, the infinite banking concept, and doing everything that I just told you we need to be learning how to do with our money, which is treat your money the same way the banks treat their money. Move it. Move your money. Keep it moving like that river and constantly recycle and recapture the dollars.